Hello, everybody. My name is Michael Scott Forehand. I'm with Symmetry Financial Group, and we're here today to talk about the Debt Free Life program that's offered from Symmetry Financial Group. Today is April the 21st, Thursday. This is our monthly DFL presentation / training event, and I'm pretty excited today. We're going to go into a little bit the basic solution right now, which is the next probably 20-30 minutes or so. And then we're going to have some Q&A, and then we're going to go into business debt-free life solutions per requests from Tuesday. So let's get started. So what is debt-free life? So debt-free life is a proprietary system that's being offered by Symmetry Financial Group. And if you were here earlier, then you heard Lisa Bijol give us an excellent explanation about what debt-free life is. And I'm just going to go a little bit deeper as we go through this. And what debt-free life is, it's designed to answer these two questions. And if you ask these two questions to yourself, if you're like me and you're that you're 100% sure that you're gonna have a great retirement, then you're pompous and you're probably wrong. And if you're not like me and you're a regularly live human being, then you probably will answer that question as no, you're not certain that you're gonna have a great retirement. In addition, that statement that you see on the next part, pay off your debts in 9 years or less, including your mortgage. What we're finding really with these programs is that we're paying them off 15 to 27 years early. And that's not by mistake. It's not by chance. It's by design. And we'll go into that design here in a few minutes. So most Americans, when we're brought up, this is where we end up, unless you've met with a debt-free life specialist at some point. And the problem with this scenario is it's not where we were supposed to be. 74 cents of every dollar we make should not be spent on our taxes and our insurance payments, which is unfortunately where we are. So our goal here is designed to get you out of this cycle, to put you in a situation where you're not spending as much money on taxes and interest, where you've got more money left over for lifestyle and you've got more money left over for savings. Because if anybody has any illusions about saving only 3% of their income, what it's going to be like when they retire, if you think you're going to have anywhere near the same amount of income that you have now, you are mistaken. And if you're relying on Social Security, God help you. So let's move forward. So this is where we are. Most Americans make plenty of money. We make about $2 million in the average American's lifetime. That is a lot of money if you spend it correctly. The problem is most of us don't. And because we don't spend it correctly, we're left with that last number, 3%. We're left with about $60,000 of retirement, and we are forced to rely on our pensions, and Social Security is another pension, and rely on Social Security, unfortunately, for our income. So where the day we're working, we're eating steaks and chicken and nice fresh vegetables and fresh fruits. And the day after we retire, unfortunately, because we're on a fixed budget, we're eating ramen and we're eating tuna fish, and we're having to eat lots and lots of canned stuff. It's unfortunate, but that's the way it happens. So our goal is to not allow you to be that funds at retirement person with $60,000. We don't need you to make any more money than you're making right now. We're just going to teach you a different way to spend the money. So moving on. So if you are a person who is struggling with debt, chances are you've reached out, you've done research on the internet, you've Googled some stuff, and you've met maybe with a debt consolidator or a debt negotiator or a debt counselor or a credit counselor. And you've met with these people, and they all play from the same playbook, which is they've got 6 different pages in their playbook, and they're all going to tell you to do one of these 6 things, or maybe all of these 6 things. And the problem with it is only one of these things works with regularity. You can work harder, but for how long? You can spend less, but for how long? You can save more, you can refinance, which doesn't make any sense. All that means is you're taking one debt and replacing it with another debt. Consolidation, that doesn't make any sense. You're putting a bunch of little debts into one big pile of debt. It's not getting you anywhere. The debt snowball is the only thing that works with regularity. And unfortunately, most of the time, what people think of as a debt snowball is actually not a debt snowball. It's a debt stack. And debt stacks are inefficient ways to eliminate debts. And we'll talk about that in a few minutes. So let's move on. So the better way, getting out of debt, what we want to do is we want to move you from the left side of your screen to the right side of your screen. We want to change the argument. We want to make it so that you're not spending 40% of your dollar on taxes, where we're only spending 30%. Make it so you're not spending 34% of your money on interest payments, which gets you nowhere. We want to make it so you're only spending 22%. And if we're looking at the same pie, the same amount of money in the same pie, if I reduce the amount of taxes you're spending by 25% and the amount of interest you're spending by 43%, where's that money going? It's going into the other pieces of the pie, which is your lifestyle money. What do you spend for your car payment, your mortgage payment, your power bill, your light bill, your fund money, your Netflix bill, all that stuff? And then what are you putting in your retirement? The 3% on the left side of your screen versus 15%. And let's do the math. This is all the stuff we talk about today. It's all math. And math doesn't lie. It's not magic. It's just math, and it doesn't lie. So if I can change the amount of money you're spending for your future from 3% to 15%, what have I done? Is it a 12% increase? No, it's actually a 500% increase. So if you look at that previous slide where we talked about the average person having $60,000 to saved at retirement, then we're talking about it changing that to $300,000. And I don't know about you, but for me, it's a heck of a lot easier to retire with $300 in a retirement program, $300,000 in a retirement program than it is just 60. So at that $300,000 mark, I probably don't need to go eat tuna fish and ramen. I probably don't need to downsize my house unless I want to. I probably don't have to, at 65 or 70 years old, go out and mow my grass. I can probably pay some 20-year-old, 18-year-old to come out and do it for me. So let's move on. So how do we do it? So the process is simply by taking a hard look at your finances, a hard look at the way you spend money, and putting you into a situation where you're spending money in a more efficient manner, and we're able to capture that significantly increased portion for your savings, for your future, for your retirement. More importantly, look at that lifestyle number, 33%, and previously it was at 20 something. We know that if we structure these programs in such a manner that you have to tighten your belt, you're gonna do that for a little while, but you're not gonna do that permanently. So these programs are structured so that over time, your belt gets loosened. You actually have more and more money that you're able to spend for those lifestyle things. And you can actually maybe get back to the point where you're taking an annual vacation. Okay. So the idea is that we want you to live closer to what this was supposed to be like, not what it's become. And all those other things that you see there, all those other bullet points, these are all part of the equation, all part of the process of getting you to where you need to be. So there are, and I've done some studies. I taught a little bit about this, I guess about 2 months ago, about the different programs that are out there. I'm not going to say any of their names because I don't want to advertise for them. But I can tell you that a lot of them use similar methodology. They use similar thought processes, but they all have Achilles heels. And the main Achilles heel with all those other programs is they do not plan for an emergency. So if you have a program out there, for example, that uses a home equity line of credit as a component of your private bank, if you die, what happens to that home equity line of credit? It doesn't go away. All that happens is you just gave away equity in your house that your family doesn't get to keep now. So a home equity line of credit is a bad way to go. There's other programs out there that will use different types of life insurance, maybe an IUL. I'm going to tell you that an IUL in theory will be okay. The problem is I can't point with guaranteed accuracy of where I'm going to be in 2 years. I can't point where I'm going to be next year. So anytime you have a program where the return and the growth is variable, then you don't have control and you don't have proof. One other thing about that home equity line of credit, anybody have any idea where your home equity line of credit interest rate is going to be in 5 years? I can tell you it's going to be higher than where it is now, because home equity line of credit interest rates typically adjust every 5 years. So that's why those HELOC versions of programs are really bad ideas. So all I can say is all of those programs have an Achilles heel. None of them prepare for what we do here, which is the emergency piece. That emergency fund, when you put money in the program, it's always there. You never take it out. You never touch the principal in the program. That's one of the tenets of these programs. But the emergency fund is hidden. It's still there. The money's still there. It's growing. It's earning a guaranteed interest rate for you. It's earning a dividend for you, but you can't see it and until you need it. And if you ever really, really need it, it's an emergency fund. So we want to make sure you're touching it for the right reasons. And it is truly an emergency, because if you ever need to get to it, the program's over. That's what happens when you access that emergency fund. You're canceling out the program. So when we compare this to other solutions, and I've already done this illustration, how does this program compare to IRAs? How does this program compare to programs using IULs? How does this program compare just to putting money in a bank? Okay. The three primary pieces there that you see: tax-free, tax-deferred, and taxed. That's the result of what happens when you put the program in different, when you put your money in different kinds of programs. So if I use the same $10,000 investment over each one of those types of programs: a tax-free program, which is our debt-free life program; a tax-deferred program, which would be an IRA, any kind of IRA, TSP, FERS, KEO, SEP, 401k, 403b, whatever; or a tax program. That's me putting my money in a bank because I think it's safer there. Okay. That's the result you're going to get. It's the same investment for the same period of time, assuming the same interest rate and assuming the same tax rate. The math doesn't lie, people. This is the way that it is. So anytime I can grow a program, and this is why that first column, the tax-free version, the debt-free life version, this is why that first column performs so well. Anytime I can do this and not grow my tax, I'm going to win. Okay. Even if you have an IRA that outperforms one of these programs for a year or two, as soon as that IRA lays flat for a year or goes down for a year, this program will then pass it. This is the turtle versus the hare. This program will pass the IRA's growth, and the IRA will never be able to catch up. Okay, let's move on. Welcome, DJ Tax-Free. So this is a financial instrument. Okay, all financial instruments work in the same phases, and we're going to talk about that later this evening. Maximization, accumulation, distribution. So in this case, the maximization phase of a DFL program is characterized by getting you out of debt. The soonest we get you out of debt, that means you've reached the pinnacle of how much money you're going to be putting into your retirement program. So the faster I get you out of debt, the more time you're going to have to stuff your retirement program in the accumulation phase. That's the goal. Getting to the accumulation phase. So the accumulation phase is I've reached the maximum amount of my annual contribution into my debt-free life program. I've reached whatever that maximum is. It's either by contract, because that's the way I structured it to begin with, or because that's really where I want to be. I can't afford to put any more in there. I don't want to put any more in there. Okay. Accumulation phase. Distribution. Distribution is how are you taking the money? And the distribution phase has so many different ways you can use it. You can certainly use it just as a simple income production piece. I can say, I'm going to withdraw $30,000 a year during the distribution phase of my program. And depending on how your program performed, depending on how you used your program, we'll talk about that, and I'll show you some examples of that in a few minutes, then you may be able to take more. Maybe you have to take less, whatever. It's your bank. It's a private bank. You own it. You control it. You're the banker. You do what you want to do with your money. Okay. The only thing I would caution you on is that distribution phase. You're not working the program anymore. You're not contributing to the program anymore. So the program is going to grow at a slower rate, kind of, but you still need to watch it. You need to look at, if your program made $60,000 in interest and dividends this year, if you want your program to stay level, then don't take more than $60,000. And the good thing is I don't have to worry, right? Lorraine Breitkreutz, if I need to take $30,000 out of my IRA, I have to take 40 because I have to pay taxes on it, right? And here, if I want to take 30, I just take 30. I don't have to worry about taxes. Aha! We get to tell the IRS to go pound sand, right? Love that. Love telling the IRS to go away. So let's move on. This program has been around for a long time. First one of these programs was done in 1904 by John D. Rockefeller. He happens to have done that program with one of the companies that we use. But this program has been done by the wealthiest segment of the population since 1904. Back then, the phrases infinite bank, or private bank had not been coined yet. So back in 1904, it was simply called life insurance, which is what Lisa Bejol talked about earlier. Okay, so he was doing a private bank, he was doing an infinite bank, he just didn't know what those words meant. They weren't in his vocabulary at that time. He was doing life insurance. All right. Since then, lots and lots and lots of people have done this. J.C. Penney did this as a business DFL. It wasn't called DFL back then. It was called a business life insurance policy or a business private bank. He did it so that he could draw money in the lean months to be able to pay his employees. The Rothschilds did this. Every steel magnate, all the railroad barons, all the early oil guys, JP Morgan Chase, Woolworth, all those guys did these programs because they know one thing. And if you think, if the wealthy know anything about anything, they know something about money. And they know if I can avoid paying some tax, it's better than paying any tax or paying all tax. Okay. So Disney did this. He used this as a funding vehicle for both Walt Disney World and Walt Disneyland. Ray Kroc did this when he funded the first 10 McDonald's units that he opened up. Doris Christopher did it when she opened Pampered Chef. Warren Buffett with Berkshire Hathaway does it to this day. He still does this because it's a solid program. It uses two key financial instruments, an infinite bank, private bank. It's structured as a life insurance policy and what a debt snowball, not a debt stack, a debt snowball. Let's move on. So all these bullet points that you see here, these are all things that we're going to do that's specific to life insurance. Some of these, you can use some of these other things with some of those other vehicles that are out there that fail. But with this program, using a life insurance vehicle, we're taking advantage of a couple of key things. A lot of that is talking about borrowing from policies cash value with no penalties of tax. Yep, that's IRS tax code, people. When you bought your mortgage, did you have to pay tax on the loan that you got to buy your house? No, you did not. When you got that loan to buy your car, did you have to pay tax on it? No, you did not. Why? Because loans are not taxable. Okay. Not taxable unless the lender forgives you and decides to send you a nasty gram known as a 1099. And then guess what? You're paying tax on it. Merry Christmas. So if I can repay my loans relatively quickly or don't pay them back, I'm going to repay those loans using this program. That's another one of the tenets of this program. We're going to leverage the program by using the program to pay itself off. Financing future purchases. If I don't ever have to go to the bank to buy a house, to get a mortgage, and I can borrow the money from myself, what would you rather do? Do you want to let somebody else tell you that you've got to bring 200 pieces of paper and get all your past, your pay stubs and all that stuff just so you can get a loan, just so they can charge you through the nose for a loan? Or would you like to tell them to go pound sand and take the loan from yourself? At worst case, a net cost of money of 0.85%. Does anybody know where you can go borrow money at 0.85%? Anybody? Yeah, you can't, right? Not unless you're talking about 0.85% per day, in which case you're probably talking to a bank. All right, so let's see how these programs actually work. These are some of the people, the early folks we did back in 2019. Their results are standard. The reality is what I'm seeing is we're paying off debts. Average is about 7 years. The fastest I've ever seen is 2.3 years. The longest I've ever seen is 15.8 years. Okay. And that's somebody with a 30-year mortgage and some student loans. Student loans are evil, people. All right. So let's move on. Let's see how it works. How do you spend money right now? Well, the way you spend money right now is you take that money, you make the money, you deposit it into your checking account, right? That's how I make money. I get deposits into my checking account. And then my bank, because they love me, hello, dog. My bank, because they love me, they decide to lend my money out every night over and over and over again and make money with my money. And because they're so happy that I put my money in their bank, they're going to pay me $0 to use my money and make money with my money. The average dollar is lent out 7 times before you spend it. The average dollar is, they can make, typically a bank will make up to 61% with your dollar. They'll make 61 cents on every dollar you put into your bank. And how much do they pay you? $0. And then when the time comes that you have to pay your creditor, The money gets transferred. You tell your bank, hey, bank, go ahead and pay my car off for me. What happened? The bank says, okay, sure, no problem. Thank you very much for letting us use your money. We're going to pay you nothing, but we're going to go ahead and pay your debt. Listen, Bajul, let me ask you a question. In this scenario, trading your money for reduced debt or increased equity, either way, what's your gain?
Well, not having to, being able to take my money and putting it into a place where it's going to constantly earn. So I think that's the hardest part, trying to explain it to people, is that their money is still going to be in the DFA.
I'm asking you a simple question.
Okay.
In this scenario,
yes.
Okay. What is your gain moving your money from the bank to paying your debt?
$0.
Right. So you've traded exactly X amount of dollars for exactly X reduced debt, or exactly X reduced. Thank you. Did I get the thumbs up on that one, DJ? Yeah. Explain a little bit better. Right on. All right. So you're trading X for X. You have 0 gain. Okay. There's a better way. Let's talk about how we do it. You do the same thing. You're making the same amount of money. The money still gets deposited. It gets deposited into your checking account. But here's where this changes. I'm going to take money from my bank and I'm going to move it into my private bank, which is known as a whole life insurance policy. Yeehaw! I'm taking money out of my bank and put it into my private bank. Now that whole life insurance policy is particular. It is specific. It is called a participating whole life insurance policy. And that word participating is very important because it allows us to participate with the profitability of the insurance company. I'm going to ask a couple of rhetorical questions that I already know the answers to. First question, does anybody know a bank that's failed? Of course you do. Does anybody know of a investment company that's failed? Lehman Brothers, Bear Stearns, right? Can anybody name an insurance company that's failed? You can't. Why? Because insurance companies are the most profitable companies on the planet. Yes, you'll have fad companies. And yes, I'm going to call Apple a fad company. Just like International Business Machine back in the 1940s was a fad company, which is now IBM. Just like Xerox was a fad company back in the 1970s. Where's Xerox now? Okay, so these technology companies come and go. Biotech companies come and go. Okay, do life insurance companies come and go? They don't. So what am I doing? I'm saying, hey, Mr. Bank, I want to take some of my money out of your bank. I want to put it into my bank. My bank happens to be held in the most profitable company on the planet that's never had a problem paying a dividend, that's going to give me a guaranteed interest rate, that's going to be completely immune from the market. I don't care whether the market goes up, down, or sideways. I'm still getting paid. Why? It's in my contract, people. This is a life insurance policy. All life insurance policies are contractual. Okay, and that's also another key point here. Because it's a contract, that means I'm not subject to IRS banking laws. Because it's a contract, a federal judge can't order me to limit or eliminate money from the program. Because it's a contract, I am tort proof. I can't be sued and they take my money. They can take my house, they can take my car, they probably could even take my dog, but they can't take my life insurance and they can't force me to liquidate it. Okay, not that I'm saying go out and try to get sued. That's not what I'm saying. I'm just saying if you have your money in a bank, it is not tort proof. If you have your money in an IRA, it is not tort proof. If you have your money with Goldman Sachs, it is not tort proof. You can lose it all if a federal judge or even a local judge decides. Okay, the IRS can touch it, tax it, drain it, garnish it. In this, we're completely immune to all that. So I'm off my little soapbox about how safe this is. Now let's talk about how the rest of the program works. I have a whole life policy that's a participating whole life. The numbers I'm going to give you right now, this is just an example. This is what, for folks that go through the training on these programs, this is what we're taught. I will also tell you that after you get beyond the basics, this is not always the case. But right now, when you do one of these standard programs, I'm going to have 21% of my premiums go to pay my whole life policy. I'm going to have 2 other riders on that policy. I'm going to have a term life rider and a paid up additions rider. Let's just explain those. The term life rider, I'm going to have about 11% of my premium payments go to that term life rider. Why? That term life rider acts as an umbrella. It says, hey, IRS, nothing to see here. Move on, move on, move on. So as long as that term life rider is in place, I can grow cash underneath this up to the limit of the combined amount of life insurance without the IRS ever being able to tax me on it. Okay. That term life rider creates this ceiling that's this, and it's actually, it's not, it's an illusion, but it's real with the way that the code reads, creates a ceiling of life insurance. Okay. So that I can grow the cash value. Now, finally, paid up additions, 11% is going to term life. Paid up additions, 68%. The majority, more than 2/3 of every dollar I spend is going into paid up additions. Why is that important? Let's go back to that discussion earlier. You ever know of any life insurance companies that have failed? No. So do you think a life insurance policy is a pretty secure thing? Yes. Who else believes you? Every bank in the country. Okay. So if you look at Wells Fargo, for example, 48% of all of their assets are what's called bank-owned life insurance. That means they've got, I think the number was $28 billion of bank-owned life insurance that they own, which means they think it's a pretty safe investment. So if you have a life insurance policy that's a paid up addition, right? What does paid up addition mean? It means it's paid up life insurance. Okay. So if I have paid up life insurance and I know that I spent $1,000 for it and it was worth $1,000 when I bought it, how much is it worth the next day? $1,000. How much is it worth 10 years later? $1,000, assuming I'm still alive. How much is it worth when I pass? $1,000. So what we have is a $1,000 asset that will never and can never lose value, that I do not have to spend a penny to maintain value. It is a perfect asset. Banks know it. That's why there are all these viatical settlement companies out there that say, hey, if you've got a life insurance policy worth $100,000 or more, don't cancel it. Call us first. We'll buy it from you, right? That's what they're doing. They're buying that life insurance policy, paying you pennies on the dollar. And then who's their number one buyer? Could it be the banks? Yes. The number one buyer of viatical settlement company purchases are banks. That's their main source of finding those life insurance policies that are paid up. So what does that mean? That means the banks know that it's a safe investment. So banks recognize investments or assets as one of four classes, tier 1, 2, 3, 4. As an example of a tier 4 investment asset, that would be like a loan that you lend $1 million to a 20-year-old to go open a restaurant. Restaurant's pretty risky to begin with. 20 years old, pretty risky, really risky. $1 million, really, really risky. What's the chances they're ever going to see that money again? Pretty slim. That's why they charge so much interest for that piece. So they're going to make as much as they can up front. They're going to insure it, maybe get an SBA to back it. They're going to collect whatever is not paid from the SBA so they can go ahead and do the loan. That's how that works. So that would be considered a tier 4, very risky investment. Tier 1 investment, gold. Well, let's compare gold for a second. So what happens if I could use this vehicle, which is a paid up life insurance policy with zero cost to maintain, with a guaranteed known value in the future that is subject to a little bit of market fluctuation based on the dividend, or I could put money in gold. Does anybody remember a time where gold actually lost value? I do. Okay. So gold traditionally goes up, but it does do this somewhat. Okay. So I don't know what my gold is going to be worth. I also know that I'm going to have to spend money to defend that asset. I'm either going to have to store it in a security with security, or I'm going to have to pay somebody to secure it for me. Either way, there's an asset management cost, maintenance cost associated even with gold. So in that situation, that's why banks don't buy tons and tons of gold. They buy this stuff because this stuff has guaranteed value. All right, have I beat that horse dead enough? Everybody understand where we're talking about here? $1 goes in, 21 cents pays for whole life, 11 cents pays for term life, creates an umbrella, 68 cents goes to paid up additions, which is considered cash. Aha! Do you remember that revolving little wheel that we had where the bank was making money with our money every night overnight? Well, guess what? We have our money in our private bank now, which we're calling a DFL bank. We are making money, compounded interest with our money it's not every night, it's actually once a month, depending on the carrier. But the point is that now we're making money with our money. The bank isn't making money with our money. Okay. So as I'm making money with my money and I'm putting money into the program, now I'm going to bump it up a little bit. Let's say I'm paying $1,000 a month. Is that scary? Shouldn't be, because almost everybody out there who's got some debts, that's about what you're paying for debt service, right? With a car, with a mortgage, with all that other stuff. Yeah, $1,000, maybe two. One I did last night was $4,800 debt service. Okay. So if I can repurpose some of that money and put it into a place where it's going to work for you for the rest of your life, rather than you working for it for the rest of your life, who wins? You do. So the way this program works, I spend $1,000 just to make the math easy. $210 goes to pay for my whole life. $110 goes to pay for my term life. $680 is put in paid up additions. So let's go a little bit deeper into paid up additions. That is life insurance. It is paid up additional life insurance. I'm trading dollar for dollar or better. Okay. And I'm getting immediate recognition from the carrier of cash. What does that mean? That means the carrier says, look, you just gave us $680. So we know that the $680 I'm going to have to pay you as a life insurance policy when you die. We've already got the money. So we've got no risk. And we're going to take that money and we're going to invest it and we're going to hedge it and we're going to leverage it and we're going to duplicate it and we're going to compound it over and over and over again. We're going to make a ton of money with that $680. We're going to give you a little bit. Okay. The little bit they're going to give you is anywhere between 12 and 25 times what a bank's going to give you. Who's your friend? Okay. So now I've got my money in my paid up additions. The lender, the carrier in this case, the carrier looks at that paid up addition value as cash value. They pay me by contract a guaranteed interest rate every month if I'm doing monthly compounding, or every year if I'm doing annual compounding. Right? Okay. So if I'm doing monthly compounding, and I'm not going to talk ill about any other companies on here, because there's only one company that does monthly compounding. If I'm going to do monthly compounding, even if the compounding amount is the same, all right, a little bit deep here, folks, math. Okay. If I have 3% that gets compounded monthly or 3% that gets compounded annually, which one's going to be higher? Am I doing it right, Keith? Am I doing it right? Yep. Monthly, annual, right? Even if the guarantee for both of these programs is a 3% annual gain, the monthly compound is going to be higher, potentially. And that depends on how you fund the program. So if you put more money in the program in the beginning, that means you've got more months where the compound of the compound is growing. In theory, if you maximize your program on the day one, you should be able to get about 0.65% interest higher. Put that into perspective. When I say 0.65, let's see, divided by 3, that's 21.7% gain, higher than what they're advertising, than what they're telling you they're going to guarantee, right? So that's just one thing to be aware of. So now, how does the program work? How do I use it? How do I get the money out? How do I get my money out? Well, if you're smart, you'll never take your money out, because the minute you take your money out, that means you're canceling the program. So you never want to touch your money. You never want to touch the principal, because the principal, as soon as you get it in the bank, it is actually structured as paid up additional life insurance. Okay. You can sacrifice the life insurance and you can get paid a cash value, or you can leave it in there and let it work for you, get compounded at least every year for the rest of your life until you die. And then, oh, by the way, leave your family with one hell of a legacy. Okay. So how do I get money out? I take a loan. I take a loan from the carrier. Does the carrier care that you want to do this? No. We had one of the companies on a couple of weeks ago. He said, no, it's your money. Please take it. That's why we live. That's why we exist. That's why this program is here for you. That's why the wealthy have been using this since 1904, because they can put their money in the program and continue to use it, even with the money being taken out and being used for liquid. If I do what I just said, Lisa Bijol, I put my money in the program. Okay. I let the money sit there and it grows and it grows and it grows. and then I take a carrier loan, like it is on the screen, and deposit the carrier loan into my bank,
Yes.
and then tell my Wells Fargo to pay my debt, where's my money?
It's still earning dividends in your DFL bank. Whoop, whoop, whoop.
It's still earning dividends and interest in my DFL bank.
Yeah.
Does the carrier care about lending me money?
No, they do not.
Because it's already collateralized, right? Because my money's still in the bank, right?
Exactly.
Does my creditor care where the money came from?
Not at all.
They just want to get paid, right?
Exactly.
All right. So Lisa, in this situation, I have a debt. The debt's paid off. I have my money. What's my gain?
Well, all of your money is still sitting in there earning dividends. So it's a win-win situation. You've paid off your debt, probably saving some interest on that end if you're, if it's a credit card or a bank loan or car loan.
Tonight, playing the part of Scott Forehand, we have Lisa Bijol. Playing the part of Keith Fonseca, we have Scott Forehand. So what you're saying is you have your money and your debt's paid. So your gain is 100%.
Exactly.
There you go. How'd I do, Keith? Yep. Right on, brother. All right. So here's the deal. The deal is I'm using their money to pay my debt. My money is still in my bank earning interest for me for the rest of my life. So I have 100% gain the minute I pay my debt using this scenario. So which way is better? The way you're doing it, where you get zero, or this way, where you gain 100% plus an asset that's going to be earning interest and a dividend for you for the rest of your life, creating a massive legacy for your family. And oh, by the way, creating a private bank that you can borrow money at a net 0.85% net cost, worst case scenario. Sign me up, right? Okay. So how does it work in real life? Here's an example. If you've been on any of these before, then you've already seen this. So let me go ahead and stop this real quick so you can see my PDF. This is a standard family. Actually, this family had a lot of debt. They had a lot of little debts. They had credit cards, back taxes that were owed. They had a couple of car payments. They had both been married before, so they both had house payments when they came into it. The husband was a truck driver and wanted to buy his own rig, which he's already bought, by the way, 2 now, since this program was originated for him. And the wife was finishing up her doctoral program, which she now teaches at William & Mary. Okay, so this is their case, and they're in debt for 40 years. Everybody see that? Anybody know why? Anybody understand why? Look at that right there. Because she's got $108,000 of student loan debt, which she thought was a great idea to have in deferment. No, all you're doing is adding to it and growing it over time if you can't get it forgiven. And there's no guarantee you're going to get it forgiven. So she's in a place where they were going to have to pay that student loan off over 40 years. This is their real debt, $584,000. If they had the ability to stroke a check for $585,000 and get out of debt in one day, they could have and should have. They didn't. It's financed. That means their true debt is $767,000, $182,000 of scheduled interest, most of which is student loans. Why? Because again, student loans are evil. So going here, 7.8 years. They are now in the 3rd year of this for them, and they are here already. They're paid off, already paid off one of the cars. They're getting ready to pay off the second car. So they've come a long way in a short period of time. And their debt snowball, yes, their debt snowball is $2,000 a month. Okay. It's money they were spending already. We didn't add anything. Here's their little, this is your aha moment, TJ McCutcheon, your aha moment. They had $182,000 of scheduled interest over 40 years. We saved them $70,000 in scheduled interest, got them out of debt in 7.8 years. Where's the aha moment, TJ? It's right here. $4.8 million liquid cash if they use this program all the way out to age 40. So let's summarize. So if they did the program they were on, in 40 years, they'd be completely debt-free. They'd have 100% equity in 2 houses and have absolutely zero left over for retirement other than what Social Security is going to pay them. And now with this program, they're out of debt in 7.8 years. They've got $4.8 million liquid in the program in 40 years. And oh, by the way, do you see that second number, TJ? 5.96 million. That's because why? Because this is life insurance, and the life insurance policy grows. So that extra $1.1 million is actually a fully paid up life insurance policy. Which way is better, TJ? Debt-free equity in 2 houses, or debt-free equity in 2 houses, $4.8 million in liquid cash and $1.1 million in life insurance. Which one's better, TJ? Right.
Debt-free life all day.
There you go. And we never told them to go out and get a second job, eat tuna fish and ramen, save more money, spend. We never did any of that. We don't have to. That's the beauty of a DFL program. How did it work for them? This is how it worked. You see each one of those yellow years. That's a year. Each one of these is a year. That's a year where they paid off something. I want you to just to get an idea. Let's do the math real quick. So in year one, they paid off $14,900 worth of debt. They borrowed money to pay off $14,900 worth of debt. At the end of the year, they owed $8,629 on that loan that they took. And they had $12,225 liquid cash in their account. To me, that looks like they paid off $14 million or $14,000. They still have $12,000. They only owe $8,000, which means they actually paid off debt and still had leftover money. That's what it looks like to me. Second year did the same thing, but this second year, they have $40,000 left over. Things are getting exciting, right? This is where they just finished last year, and then boom, $58,000 of the debt paid off in the third year. Why is it taking so long to get to those big debt payoffs? And that's because the nature of these programs is to use 2 separate financial instruments: an infinite bank, Debt Snowball. This is why. This is their Debt Snowball money over here, the roll-up deposit. This is what's happening. So it took them 2.09 years to get to the point where they're putting an additional $2,000 a month into their program. All they're doing, they borrowed money to pay these debts off. All they're doing is paying themselves back. And they're paying themselves back at the rate of $2,000 a month. Why? Because all these other debts are already paid off. So they don't have them anymore. They were just repurposing the money. They're not going out and making more money. They're not spending more money. They're not tightening their belt. They're not eating tuna fish and ramen. They're not changing their lifestyle. Actually, their lifestyle has changed completely because they've got 11% more spending money than they had before now. But this is why it works this way, and then it's going to jump up again here pretty soon because they're going to be putting $2,700 a month into their Debt Snowball. Now, this gentleman told me, he was 36 years old, told me he wanted to retire at 75. That's why at age 76, he spent 0. Ready for some magic math, William? Mr. Dallenberg? Here's some magic math. At age 76, I spent 0, right? I had $5.25 million in the program. At age 77, I spent 0. I had $5.46 million. Wait a minute. Does that mean I grew $210,000 that year without spending any money? Yes, it does. Okay. Not magic, folks, just math. That's the effect of compounded interest plus a dividend. Okay. So moving on, this program is usable by anybody, whether you have just a mortgage, whether you have no debt. And if you have no debt, then what you're doing is you're starting an infinite bank. It's the same situation. Bloomberg did a report on this about 3 months ago about how the wealthiest segment of the population saw the warning signs, just like I did, about where the market's going, just like you guys should see. And you guys should be freaking out if you've got your money in the market because you're getting ready to lose your behind. Okay. And it's already started. Okay. So what Bloomberg says, the wealthiest segment, wealthiest 1% of the population are moving back to this instrument. Why? Because I get gains without market exposure, because the IRS can't tax me, because I can use it and leverage. Remember that little scenario we ran earlier about what's your gain? 0% the way you spend money now, or 100% if you use it with a DFL program. Yeah, I get to double my money. Every time I pay off a debt, I'm doubling my money. They know this. The wealthy know this. Okay. So how do you do it? Well, you contact whoever brought you here, and you get up with them and do one of these DFL programs and you do the math. We all have access to some very expensive software that shows us with clarity how long it's going to take you to get out of debt, the order that you're going to pay off the debts. Have no illusion. If you've got 6, 8, 10 debts, there's a very specific order that you have to adopt that's going to give you the best amount of money in the end. There's only one. And I can tell you, I've done the math manually before. The very first time before the software is available, I did the math. It took me 6.5 hours to do one illustration for a 7 debt client, one illustration. And if you do the math and figure out how many different permutations there are, how many different ways you could combinations you could do, there's not one, there's thousands. Okay, so it took me 6.5 hours to do one, and it was the wrong one. Okay, so once I got the software proved that I was doing the wrong one and showed me the right way. So thank you very much for the software. So the idea here is that there's only one way to do it. There's only one best way to pay off the debt. There's only one best way that's going to give you the most amount of money in the end. The software shows us. Okay, you can play with it. I've got a client right now who had over $1.1 million of the debt. We're down to about $600,000. But he told me the other day, good, there's no names on this. This is his stuff. This is his debt workup, right? That's a lot of debts, right? Yeah, it was 31 debts when we started, okay? And he said, Scott, my program's not working the way that you told me it was going to work. Okay, let's figure out why. So he's paid off 8 of the debts out of order. And that's why. Because he thought that it was better to pay off a smaller debt than it was a larger debt when he had the opportunity to pay off that larger debt. And this is not just a function of how much interest we're eliminating. It's a function of how fast we can build that debt snowball. So if I want to pay off $2,000 of one debt so I can get a $29 a month debt snowball, or I can wait 2 months and pay off $4,000 to get a $429 debt snowball, guess which one's the right decision to make? And never did I say what the interest rate is. The interest rate is irrelevant. If you run these programs and you look at this stuff, you're going to see with regularity that it is almost never the highest interest rate thing that's paid off. It's almost always based on how quickly I can build a debt snowball. So if you took anything out of this tonight and you're trying to do this on your own, just note that it is not, the interest rate issue is not the highest and best. It's rare that that's the case. All right. So that's the end of that little presentation. Mother Teresa, your hair looks wonderful. Let's go ahead and have some questions for a few minutes, then I'll show you the business DFL stuff. Oh, there's a Katie Halter. Hi, Katie. Anybody have any questions? If you do, just unmute and start asking.
I got a question, Scott.
There we go.
When you're working with, yes, sir. When you're working with businesses, and I saw your presentation, with them using the people that are paying the taxes and so on. I think it's a fabulous concept. I've got some prospects for that. But are you working with them directly or with their accountants, or how do you sell that?
Right. So when I'm working with the business DFL client, the first thing I do is I do one of these illustrations. The second thing I do is I have them explain it to me.
Okay.
Okay. If they can't explain it to me, then they can't do it. So they have to understand the ins and outs. And the third thing I do is I open myself up for a conversation with their CPA. So their CPA, because a lot of CPAs don't know some of these things like tax code 162. Most CPAs are not familiar with that. They have to go look it up, and then you have to explain it to them how this is an executive, blah, 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 blah. And then the other piece is the concept, one critical piece. So whether it's a business DFL solution or an individual DFL solution, under no circumstances can you use an advanced strategy as a primary funding vehicle. If you do, the program will fail. Okay. So so let's say I have $100 a month program, but I want to run $30,000 of, let's say, payroll through that on a monthly basis. Is that program going to work? No. Okay, there's got to be a large enough DFL to support maintaining it, because you're going to be putting that 30,000 in, and it's going to be growing, and then you're going to be taking 30,000 out to make payroll. Okay, so the business DFL has to be enough to support the monthly fees associated with that. And you do it again, and you do it again, and you do it again. Okay.
So one additional question there.
Sure.
So if you have somebody who, let's say it's a small business owner, maybe a small construction company, something like that.
Love it.
And it makes sense from that.
Great for this, by the way.
Yeah. so let's say that they, are you merging maybe their personal stuff with that too?
So
The business, or they're separate?
Great question. So I will tell them that what they should do is they should have separate programs for individual versus business. And the reason why is because if they have a business and they're going to use this as a business DFL, then they should take full advantage of the tax code. And they should have, if they're an S Corp trading in it, if they're an LLC trading as an S Corp, or if they're an S Corp, then they can run this program through their corporation. And instead of their social security number being the number linked to this policy, it's going to be the business's FEIN number linked to the policy, which means the business, here you go, ding, ding, ding. The business will be able to write off the cost of this program as an executive perk for the client under tax code 162, which, taking that a step further, means that if you do it correctly, then you can actually control your income by saying, you know what, I made $100,000 this year, but I don't want to pay tax on $100,000. I don't need to. I didn't take that money. I actually put $40,000 of it into my debt-free life program, my business DFL. So therefore, because that went into my business DFL, the amount of income I have to pass through that I'm going to pay income tax on is only $60,000.
Well, I'm sorry, one additional question, then I'm done. So when you're doing your, your financial information, is there any major changes or things that you're doing for that? I mean, when you're asking questions. So in other words, on there, the basic stuff we do for the consumer.
Yeah, if you're asking about the financial information stuff that
Yes.
you collect for a business, it's significantly different and much more extensive than what you're going to get for a personal DFL. Okay, and there's way too many what ifs for me to go into here.
No, that's fine. That's fine. I'm just asking generally. We can work. Thank you so much, man.
You're going to need to do a full financial analysis on the business, really, to find out and see where the money is, right?
Right.
All right.
Awesome. Thank you so much.
Thanks for the question, Mr. Dollenberg. Anybody else?
Yeah, so Scott, I just met with a young lady today, and she does not have a ton of money, but she's putting $200 a month into a Roth. She just started the Roth. She's got a very small amount of money in there. I asked her how she felt about maybe using some of that money to fund this policy. Do you think that's a wise idea?
Well, before you make that recommendation, you got to be careful about what kind of license you have, because if you don't have a Series 6, 63, or 7, you can't give advice about Roth IRAs. Okay, be careful. So from my perspective, though, I asked the question like this. So you're putting money into a Roth IRA, great, and you're putting $200 a month, great. How much have you lost since January? And how much more do you want to lose?
Right. Yeah.
Okay. So, and I'll say, there's another place you could stop that. And I'm not recommending that, this is where you CYA, you can stop that. And I'm not recommending that you stop it, but you could stop it right now until the market stops the downward spiral that it's on, and start putting money into this program where you're not going to have a loss and you're going to be capturing that money forever.
Yeah.
Okay.
Okay. And that's kind of basically what I did with her.
Yep. All right. Very good.
Thank you.
Yep. You're very welcome. Nice to meet you, Vicki.
Nice to meet you.
All right. Anybody else?
Yeah, Scott, you talk
Norma?
about, it's Norma.
There you go.
You talked about, well, I shouldn't say you talked about it. You had an illustration of something with 7% interest. Now, I understand that may not be, on current. You were comparing a savings account, a tax deferred instrument, and a whole life policy. But currently, what is the interest rate that you can expect to get? What kind of a return?
Well, you can expect a negative interest rate for the next year with any kind of IRA. You can expect a negative interest rate with a Roth. You can expect a negative interest rate with any kind of KEO, SEP, TSP, FERS, 403B, 401k, any of those. You can expect a guaranteed interest rate of at least 3% with a dividend. So if you look at the worst case scenario, the worst dividend that's been paid in the last 119 years, excuse me, 118, yeah, 118 years is 0.25%. So you can expect worst case scenario 3.25%. So you can go down, expect a loss, or you can expect a gain. For me, it's a no-brainer.
Right, because I was just talking about within the whole life insurance. Also, I just want to make sure I got this correct. So from a gain standpoint, compounding standpoint, it is better to fund these policies on a monthly basis than with an annual payment.
So it depends on which carrier you're using. Some carriers don't, most carriers don't recognize monthly compounding. Most carriers recognize only an annual compound, in which case it doesn't matter. Okay.
Can we know which ones do?
But this is supposed to be a neutral thing. So I'm not going to talk about it here, but you can reach
Come on,
out.
get out of Switzerland. Just say the words.
So you need to, and you should research that yourself. Okay. There's also different ways that different carriers respect the loan. Okay. Some carriers don't care that you have a loan, and they're going to give you the maximum gain annually. Some carriers will say you've got a loan, so we're not going to give you a dividend on the portion that you have encumbered with a loan, but we're going to give you the guaranteed interest rate. And then some carriers say, well, you had your loan out, we took 1 year of interest up front, but you paid it back early. So we're going to pay you back the interest that we took up front, pay you back the unearned interest. Some carriers do that, some carriers don't. So I would say do your due diligence, research those carriers, ask them yourselves what's going to happen with the money. Okay. And you'll be able to make your own, draw your own conclusions.
Okay.
Okay.
One more question.
Sure. Go ahead.
Are you available for hire to help out with illustrations in a special case?
Feel free to reach out to me. Okay.
How do I reach out to you?
You can email me. You can call Katie Halter. She can get to me. I'll actually put my phone number in here.
Thank you.
There, my phone number is in the chat.
Thank you.
All right.
Hey,
Any other questions? Mr. Weaver.
Yeah.
Buddy. Hey, Aaron.
Just more of a statement there for Norma. The carriers, they want your business. They will help you. They have been so helpful to me with illustrations. I'm very new in this process. And again, they're there to help. So feel free to reach out to them as well if you can't get a hold of Scott or.
Oh, I have. I've been doing it for a lot of years, but sometimes it takes a little different angle.
All right.
Norma, I'm available for hire if your client wants to be entertained
Is that right?
or
Oh, that's cool.
or confused. Just please let me know.
DJ, you are always so colorful. You just are a ray of sunshine. I just have to say that. Gotta run, but always love seeing you guys. Scott, great job.
Bye, Vicky.
I have
All
a
right.
question.
Bye. See you
Go
ahead.
later.
No,
Ms.
this is a
Birnbaum.
question. Yes, thank you. I just wrote my first DFL and I did it with my upline.
Congratulations.
It's a business one. And it's a long story. They're a young couple, they're self-employed in construction. And I was just gonna sell her a, whole life policy. And my upline says, well, she's gotta be paying taxes. So the long and short of it is that initially she's gonna fund it with taxes and there's room to grow. Now, my question is from before, if she wanted to add other expenses, would you need another one?
I don't
Or
know. I don't know how you structured it. Depends on how much room you left in there. So with every one of these policies, there's a maximum, there's a stipulated PUA amount, and there's a
Right.
maximum PUA amount. So you have to look at that number, the maximum, and see how much room is in there. If for example, if the maximum PUA is $40,000 a year, and she's putting $20,000 a year in for taxes, then she's got another $20,000 that she can put in there. So yeah, you could do it more. But if the maximum is 20,000 and she's putting 20,000 for taxes, then it will MEC.
No, we have about $34,000 extra.
Sure. Yeah. Yeah. And that's something that, when you're structuring these programs and you're looking at as a debt piece, you do need to look, the debt snowball for most of these programs gets rolling as a juggernaut about year 2.2, 2.4. So look into the future year month 26, month 28, something like that on the form. Look at how much their debt snowball is going to be, and then take that number and multiply it by 12, and then make sure that your PUA amount can cover that, can encompass that on an annual basis. That way you're creating a program that's going to be usable for them without mecking until really they're out of debt. And that's a good barometer to start with.
Hey, Scott, can I pitch in on this one? I
Of
don't know
course.
if you want. Yeah. Lourdes, I got this question from a DFL Nation person earlier today, reached out, called me and asked me about exactly what you just said. Can they put extra money in? Look, it's a different way to look at it is all the insurance carrier cares about when they're approving these policies is the amount that they have to underwrite. It's the death benefit. So what they do up front is they take whatever your whole life is, plus whatever your term rider is, plus whatever the PUA is, and that PUA is decided by a max PUA amount, right? So the carrier and the illustrator that I typically use is Foresters. I'm not Switzerland. I'm okay with saying it here, right? And they're not the carrier Scott's talking about, right? So they have a max PUA amount that's inside of the illustrator that you can manipulate. Now, here's where we separate ourselves. Just the regular insurance agent who's not paying attention does not pay attention to that number, right? They don't slide it on a scale. They don't look at it. They don't think about it as a financial expert. How does that end up affecting your client? Well, when the underwriter looks at it, they take that max PUA amount and they multiply it by 5. So if I put the max PUA amount at, say, $200,000 a year, which I've put at, that adds an extra $1 million of underwriting on top of your whole life, on top of your term that you're planning to underwrite for this client. And that client may not qualify for an extra $1 million, even though you may never use it at the outset at the beginning, right? That's what they're considering. So take a look at that, because just as a little exciting note, I said it earlier, I got an accelerated underwriting approved today for a guy who's in his 40s, but I slid back his FPUA so much that he was just under the $1 million mark, and that's what qualified him. Had I not paid attention to that, he would have had to do a paramed.
Yep.
So for everybody out there, think about that max PUA amount and how it affects the carrier's underwriting, and that'll help you, because once they're approved for all that underwriting, the carrier doesn't care. Add extra money. They want the money.
So one thing that Keith just said, just that is consistent with all the carriers. And that $1 million threshold is the piece where if you're under $1 million, you're going to be able to get, if the client's healthy enough and young enough, you're going to be able to get accelerated underwriting. So be cognizant of that. There's nothing that says you can't do 2 programs. Okay.
I have another question.
Sure.
I have, and this is a prospect, and he's also a business owner, and he's 62, 63.
Great.
I was going to say if he's too old, but we can't say that. But it's usually the underwriting based on the age. When
I
it's
did one on a 68-year-old last night. I did one on a 72-year-old last week. You can write them up to age 75.
Okay. Okay, thanks. Sounds good.
But can they fund the PUA rider after age 75?
Nope.
Yeah.
Okay. Anybody else?
Actually, I have one.
Oh,
Scott.
Bianca. Okay, she got in there. I was just getting ready. One more. All right, go ahead.
Okay. Yeah, my question is, I noticed with the illustration, you were using your family bank's illustration software. Did you hang on to that, or did you switch over to Debt-Free Life?
I use both.
Use both? Okay.
Yeah, I can run a YFB illustration faster than I can the other one, because I'm not quite as adept with the new one yet. But ultimately, when if I've got time between when I'm having a meeting with a client and when I'm going to do an illustration, I'll run both, and then I'll present usually the Symmetry's software version. There's some other pieces that are coming to that too, which I'm very excited about. Like there's going to be an opportunity to be able to show mortgage chunking, which I'm very excited about. So at that point, I'll probably completely leave YFB behind. All right. Anybody else? Great. I'm going to talk about what I want to talk about now. You ready? Hold on. So right now, I'm going to go find the little PowerPoint that I made earlier today to share with you guys. I just can't remember what I called it. Katie, what did I call it?
Scott Forehand's favorite PowerPoint ever.
Wish that was the case, but no. What did I do it on? Oh, it's on business DFLs. Okay. Probably under business DFL. No. Hold on one second, please. Oh, please.
Advanced concepts.
Nope, I called it DFL business. All right. You guys still there? So business DFL, there's a couple of things I want to, there's some similarities that we need to take a look at. And one of the similarities that's a critical piece here is the fact that the business DFL falls in line with the same process that a traditional DFL does. It still falls in phases. And the phases, you have different stopping points within each phase where you can do other stuff. So the doing other stuff piece is this. Here we go. Does my debt-free life business fill your screen now?
Yes.
Yeah.
That-
Okay. Yay.
Yes.
Sharp
My first
looking.
day with PowerPoint. Thank you. Okay. So what we're looking at here is these things follow the standard phases that a DFL, whether it's a business DFL or traditional DFL, maximization, accumulation, distribution. The difference is the things that we do within each phase. So for maximization phase, and this is what we were just talking a minute about, what can you use it for? So someone mentioned previously taxes. Of course you can use it for taxes, especially if you're a 1099, you're gonna have to pay quarterly taxes. Use it. Payroll. The first person to do this for payroll was J.C. Penney back in 1924. Okay, this is not a new concept. He used his participating whole life policy to do what a lot of people do with a home equity line of credit, which is have this nest egg of money that they can pull out seasonally when, like, for all of the folks that are out there working with construction guys, especially if they're exterior construction guys, are they doing a lot of work in the wintertime? Probably not. Do they have expenses and employees that they want to keep fed? Probably so. Great option to use for that. Equipment purchases. So one of my clients, we didn't set it up as a business DFL originally. We just set up as a traditional DFL. And he's the same client that we showed earlier today. He's using this to purchase trucks because he's a trucker, he's an over-the-road trucker. He bought his first truck 2 years ago, and now he's buying one about every year and a half. So he's getting a fleet together and he's using his DFL program to do that. So he's paying off all these debts, and what they're going to do is they're going to sacrifice paying off their homes so that they can build more wealth to buy more trucks. And then eventually, from a business perspective, that means that he gets to put more trucks on the road, hire some drivers. His business gets to grow faster than what he had otherwise. And if you've taken any of the YFB training down in St. Augustine, then you would have been taught, Larry uses one of those examples. It's the same thing, and it actually does works like a charm. And then let's talk about expansion funding. So what he's doing from a truck driver's perspective is he's funding his expansion by being able to buy more trucks. But that could mean I'm funding my bagel shop expansion by being able to fund opening another bagel shop location, or I'm hiring another personal trainer for my personal training service. Whatever, it doesn't matter. The idea is that we're leveraging the money that's in the system to create another, in business terms, we call it a profit center, to create another profit center that's going to be earning for me. And then, so it's the same thing. It's just like a debt snowball. So if you use this from the maximization phase, be thinking about this, right? Be thinking about, what do I want to do with the money? What kind of expenses do I have coming up? Am I going to, if I've got a restaurant, do I need to buy a new convection oven? Do I need to buy a new dishwasher? If so, when? Okay. And this is that process where you guys come into play, where you're helping your client. I am going to need to expand my business. I am going to need to buy that new dishwasher. It's going to cost me $3,000. I'm going to build it into my program right now as a future debt. And I'm going to start funding it right now, $50, $100 a month, whatever. So that when the time comes, I'm able to pull the trigger. I've got $3,000 cash in here. I can go buy that dishwasher, that stove. I can go buy that new rig. I can go put a down payment on that new rig. This is just about, if you can think about it, and that's what we're talking about here. This is, you've got an imagination, use it. Okay. You can use these things for anything. I get those questions all the time. Can I use this for this? Yes. Can I use it for that? Yes. Is it a debt that you can pay off and eliminate? Then yes, you can use it. Well, I have a credit card that I run $20,000 a month on, but I pay it off every month. Can I use that? No, because it's not a debt that you're going to eliminate. Okay. So this is the thought process you need to get into, the maximization phase. How can you use it? And the possibilities are limitless. Okay. Whether it's for a business DFL or for a traditional DFL, limitless. So let's talk about accumulation, right? Phase 2. Accumulation means whatever debt I had is gone. The program should be on automatic pilot at that point, but does it? So I have folks that have gone into the accumulation phase, but then because they want to do an advanced strategy called daisy chain annuity stacking, I schedule the annuity stack purchase to come out and puts them back into the maximization phase. What is that doing? Well, I'm creating another $10,000 debt that they're going to pay off in short order. What it actually does is it makes the program expand faster and faster and faster. Okay. Additional growth strategies. I want to open not just a new business and location, but maybe a completely new business. So one of the things that there's a large need for, you run into people that flip houses, right? House flippers usually have in their back pocket a hard money lender that they can go to with short notice and borrow $20,000, $50,000, $70,000 at 16, 18, 20% interest with a required payment of 6 or 8 months, because that's about how long it takes to get a house purchased, get it flipped, get the title cleaned, do the renovations, get the house staged, get the house marketed, get the house under contract, get the house closed. Okay. So in that scenario, I could become a hard money lender if I wanted to. I could charge those rates. I am not telling you to do that. I'm just giving an example. Okay. And then finally, that accumulation phase, if you're really doing it, that tax code 162 is a great place for you to determine how much money you're going to make in a business DFL. If I decide to deposit an extra $10,000 into my program, and it has to pass the CPA sniff test. You cannot do this on your own. You have to have your CPA on board, because ultimately when you file your taxes, your CPA is going to put their license on the line when they sign off on this. So you have to understand what you're doing. And there's some tenets to being able to do this consistently and effectively. Okay. But tax code 162 is a great thing if you're willing to work with it. And then finally, moving into the maximization phase. So this is exactly what 3M did. Everybody heard of 3M, right? Everybody knows about 3M, right? They make Post-it notes, right? Do you know what 3M stands for? Anybody?
Yes,
Yes.
Minerals.
Let's hear it.
Minnesota Mining Manufacturing.
Right.
What?
Yeah. Mining company.
Yes.
Minnesota Mining Manufacturing.
Yes. Did they start off as the Post-it note company?
No.
No. They started off as a mining company and a mineral developer and seller. So why are they a Post-it note company now? Well, because they had enough money available when the guy that developed Post-it notes was ready, willing, and able to sell his patent. They bought the patent, and now I would bet that Post-it notes are 90% of their income, and they have very little to do with mining at this point. So the idea when we get into the distribution phase is being, from a business perspective, is being able to have that money to expand beyond what our normal ventures would be, our normal expertise. I'm not saying go out and buy something that you don't know what you're doing, but this is that you talk about, you'll hear about people that have money on the sidelines, right? Where's that money kept? They usually keep it in an account, a bank. Are they earning anything with it? No. That's 3M. They had a ton of money sitting on the sidelines. If they had it in this vehicle, guess what? Their money would still be on the sidelines. It'd just be earning interest in them for the rest of their lives. Okay. McDonald's, another piece here. What kind of business is McDonald's? Most people are going to say it's a restaurant business. It is not. McDonald's,
Real estate.
a real estate company, right? Exactly. Right. So how does McDonald's do this? Well, they could be using the same thing. They could be using this in leveraging. There's a process called a BRRRR, where you buy a property outright. Then you take a line of credit against the property and you put smaller than the value of that first property, and you go buy a smaller property. Then you do the same thing. Then you go buy a smaller property, and you're having all these properties being purchased with the same set of original money. Okay. Same thing here with McDonald's. Do they pay $2.2 million for a piece of land? Yes. What happens? Oh, they leverage it and they go buy another $2.1 million piece of property. And then they go buy a $2.0 million piece of property, all with the same set of money. You can use a DFL program, especially a business DFL program that has a large volume of money running through it. You can use that to fund that strategy. And then finally, Kiyosaki is something that a lot of us here at Symmetry and Coolity read. He's a brilliant author, and he talks about a lot of different things. He talks about the cash flow quadrant and becoming an investor and being able to make where you don't have to worry about the money anymore. This program is a way that you can get there simply for this. And I said it earlier. If you can borrow money at a net cost of money at 0.85%, or you have to go to a bank and the best they're going to give you is probably 3, 4, 5%. Why? Why wouldn't you borrow it from yourself? And I would ask this question. If you borrow it from yourself, are you going to take yourself to court if you don't pay yourself back? Are you going to sue yourself? These programs are designed so that they're self-funding. Most of the carriers will let you encumber up to 95% of the cash value of your program. I'm going to tell you don't. I'm going to tell you don't encumber more than 90. Because if you don't encumber more than 90, then you're never going to run into a problem. There's always going to be enough money that you're getting a guaranteed interest rate and a dividend to pay the debt service on the loan. You'll never have a problem. So stay at 90. Is that it? I think that's it. Nope. Okay. So you got an imagination, use it. Okay. So this program has so many different ways that you can utilize it. If you can think about it, you can probably do it. And if you have a question about whether or not you can, ask the expert. Ask that CPA, ask an attorney, ask a DFL specialist here at Symmetry. The key part of this whole thing is that you're giving control of their future back to the client, whether it's in a business DFL or otherwise. It's all about that. It's about who controls the money. And if you can put somebody in control of their own money, as long as you're willing to stand next to them, then you're going to win. They're going to do well. That net cost of money, that's what we just talked about. Net cost is 0.85%, worst case scenario. Finally, let's talk about the last piece here, arbitrage. So if you don't know what arbitrage is from a business perspective, you absolutely need to. A bank makes money with your money because of arbitrage. They're able to borrow money at a lesser interest rate than they're charging when they lend it out. They borrow the money from you, from your checking account, and lend it out at the federal funds rate 7 times, and then return it back to your checking account so you can use it. That's arbitrage. Here, especially if you're using the carrier that will return unearned interest, you have the ability to create positive arbitrage. If I borrow money at 3.85% for a year, and I pay 3.85% upfront, and I pay that loan back in 6 months, they haven't earned 3.85%. They've earned 1.95%, and they will return 1.95%. that means my cost of money for that particular amount of money, it's not zero, it's still a gain. I'm still earning 1.05% net earnings on that money. And that, my friends, is how you engineer positive arbitrage in your DFL program. Okay. I lied. There's one more debt bullet here. Daisy chaining. You can schedule, this is what I was talking about. You can schedule an expense to expand your cash as a daisy chain expense. I'm going to buy a $10,000 annuity every 3 months. I'm going to spend $10,000 principal payment on that second property I just bought from my flipping business. I'm going to spend $10,000 every 3 months on buying a new construction vehicle. I'm going to spend $2,000 a month to buy that new bagel maker. Whatever, it doesn't matter. You can use that chunking routine in a forward expense manner simply by thinking about what you want to do with it. There you go. Now I'm done. Any questions? You guys have 3 minutes.
I'm just wondering if anybody else's head is spinning. Mine is.
Exactly.
Yes,
Is
that's
that
why DJ Jez Free's here to explain everything I just said.
Yeah, is that annuity and a forward expense tax deductible?
Is the annuity in a borrowed expense tax deductible?
No, you not borrowed, forward. You said I can
So,
schedule forward
okay, so
expenses.
great question. So no, it's not. However, it is still, it's a non-qualified account. So that means that your tax exposure when you actually exercise that annuity is going to be lessened because it's not qualified money. So you're using non-qualified money because it's a loan, right? But no, it's not a loan. You cannot use this to buy an annuity, but you can commingle funds. If you had $20,000 income coming into your bank account and you put $10,000 from your DFL program, then you've got $30,000 in there. You have to have, this is where your CPA has to come into play. You have to be able to reasonably say that I'm using $10,000 of the money that I made for my monthly expenses. And I'm using the $10,000 I borrowed from myself for monthly expenses. The remaining $10,000 that's in there from the $20,000 I made, I'm using that to buy the annuity. And as long as you can point to that and prove it, I mean, it's probably never going to come up, but it needs to be real. You can't use borrowed money to start an annuity. That's not, you're going to, every time you start an annuity, you're just going to ask that question, where'd the money come from? And you're going to say borrowed money. As soon as you say borrowed money, it's over. It's not going to pass suitability. Okay.
How about if I borrow money to fund DFL on myself or on my business?
So when you fill out the application for a DFL, it's going to ask where the money came from. If you say that you borrowed the money, the policy, the application will be declined. You can't borrow money to start these programs.
Thank you.
Okay. All right. Anybody else? Come on,
One more
Mark.
question.
There you go, Norma.
Will this recorded meeting be available to
Yep.
any of us? Where?
All of them are available on YouTube eventually.
Thank you.
Yep. So if you want, you can wait for me to post it and see, or you can go to that YouTube channel, subscribe to it, and then you'll see it as soon as it shows up.
What is the YouTube channel?
I don't know. Just Google my name, Scott Forehand, Debt Free Life.
Okay.
You'll find them.
I got a
All right.
request. And the next time you do one of these and you do a special case, can you focus in and do a slideshow on the annuity stacking strategy?
Sure. Next month in May, annuity stacking, a la DJ Debt Free.
Listen, that's a double up for everybody on this call. Help your client twice.
Yeah. Annuity stacks are awesome. Okay. Anybody else?
Where are the odds to accumulate better at the health of the wife or at the health of the husband?
You're asking a question I can't answer. Don't know. There's too many variables about that. You got to look at each person's individual. You'll have to do the math for both.
Okay.
Sorry, man. No easy
No
answers
worries.
there. All right. Well, look, everybody, I appreciate you showing up. Hopefully you got something out of this. It's 7:01. Thank you very much for hanging in there with me.
Thanks, Scott.
We've got,
Amazing.
all right, Brett, good stuff.
Thank you, Scott.
My pleasure.
Thank you, Scott.
And I'm going to go ahead and stop the recording now.
Thank you.
I can figure out how to.